The 30-year fixed mortgage rate has climbed to 6.48%, hitting its highest peak since August of 2025. Expanding the view, the 15-year fixed rate sits at 6.09%. These figures establish the baseline for anyone looking to buy or refinance right now. These housing market rates are not moving independently. They are reacting to extreme volatility in the underlying bond market, with the 10-year Treasury yield hovering right around 4.31%. To understand what is happening to local housing costs, we have to stop looking at real estate fundamentals and start looking at global headlines. The primary external catalyst driving the current market panic is the ongoing, unresolved conflict involving Iran. This specific geopolitical tension in the Middle East directly threatens global supply chains, pushing up global energy and oil prices. This dual-axis chart demonstrates the direct upward correlation between rising oil prices and 10-year Treasury yields. Investors are selling off bonds because they are pricing in a reality of prolonged, energy-driven inflation. As long as this conflict remains without a diplomatic resolution, energy markets will continue to push borrowing costs higher across the board. Domestically, this graphic displays a downward trending indicator for economic growth, hitting 51.4 on the latest Purchasing Managers Index, or PMI. The PMI is a survey-based indicator that measures the prevailing direction of economic trends in manufacturing and services. That 51.4 reading marks a one-year low for business activity growth. On the other side of the screen, we see a sharply upward trending indicator for the prices paid for materials, which just hit their highest level since last May. Growth is slowing, but the cost of doing business is rising. This specific combination of slowing growth and sticky inflation forces the Federal Reserve into a corner, eliminating the chance of any short-term rate cuts. Federal Reserve officials, including Governor Michael Barr, have explicitly stated that policymakers need to keep interest rates unchanged for some time until there is a clear path back to 2% inflation. Global uncertainty in the Middle East and stubborn domestic prices have trapped the Fed. Elevated rates are locked in for the foreseeable future. This sustained high-rate environment is actively freezing marginal borrowers out of the system and halting momentum in the housing market. This bar chart illustrates data from the MBA, or Mortgage Bankers Association, the national organization representing the real estate finance industry. It shows a 10.5% drop in total mortgage applications last week, driven heavily by a 15% collapse in refinancing activity. Even with new institutional policy flexibilities, like Fannie Mae removing minimum credit score requirements, lower credit borrowers are not returning to the conventional market. Until geopolitical stability returns and inflation definitively cools, market conviction remains low and volatility remains high. Borrowers must prepare to navigate a highly unpredictable landscape. To get specific, localized guidance for your situation in this volatile market, reach out to John McClellan, Regional Manager at Supreme Lending, by phone, email, or by visiting johnmcclellan.com.